Talk about the Federal Reserve because its stimulus has been the major ingredient for the stock market rally this year. Uri, since you do expect a downfall from here, what's your sense of when the Fed might taper? Is that what could really knock the market off its perch?
Yeah, I mean, I think that's one of the problems that the market's going to have is that, we've been propped up, artificially in my mind by the Fed. Basically, they've put a safety net under this market. And I think what's going to happen probably late summer is they start finally tapering off their purchases, and they'll probably be out of the market entirely either by the end of the year or by the first quarter of next year. And I think the market is going to have a hard time digesting that.
Jason, you think the Fed was trying to bring down some of the froth in the market by merely talking about tapering its purchases as opposed to actually doing so?
Yeah, a little bit. I mean, the Fed talking sends a huge message to the market. Ben Bernanke's been very clear with how, the rules he uses to raise rates. He wanted that 6.5% unemployment. So yeah, I think talking does send messages. And, Uri was talking about the intraday high. I'm more of a, like Chris said, more of a longer term investor and look for different stock opportunities, and there are still opportunities in different markets. But yeah, I think the Fed does notice what's going on in the market, and do they want to tighten now or taper? It's not clear, but the talk does send a message to investors for sure.
Chris, do you think tapering fears are overblown here? Right, you look at the most recent unemployment report from May, and it was still kind of a tepid number. Inflation still remains low, which would give the Fed some room to keep buying bonds here. Do you think market's gotten ahead of itself here as to the timeline on the tapering?
Well, I think there's a lot of concern, and it really hinges almost, on what the most recent economic data point is. On some days, we get, data that suggests that, the economy is doing well, and then the market sells off because, the thought is that the Fed is going to, taper sooner. Then we get, weak data. For example, Monday's ISM manufacturing figures, where we saw the order numbers for May actually contract. Then all of a sudden, the market, responds because it says, guess what? The Fed is not going to taper as soon as we think. So I think there's a lot of push-pull, but when I push back from the desk and kind of add up all the figures, it tells me that we're at best at 2%, economy this year, plus or minus. So I agree with Uri that the way the Fed starts to taper will be key. The big question is when. I do think it's pushed off a little bit. Given some of the economic numbers we've gotten, but I do think it'll happen towards the back half of the year. The big question to me is, as they start to taper off, are they, how fast are they going to taper once they start, and what does the market expect for that? Is it a quick fall off, or is it a progression over, 6 to 12 months? Well, that's the real question.
Right. Well, you've certainly seen yields react right in the bond market, and it's created a lot of volatility, uncertainty within stocks. I mean, could we see a major downdrift?
Oh, you're asking me.
Yeah, Chris.
I think there's that risk in certain sectors, right? When you see, the 10-year start to creep up, some of the more yield-sensitive names, which have done well, utilities, for example, they might trim back a little bit. Maybe some of the other defensive names. But there's another flip side to that too, which is the 10-year is kind of used to price, mortgages.
Right.
And as the 10-year moves up, all of a sudden we could start to see 4% mortgages return. That could get people who have been sitting on the sidelines into the housing market, which could actually be good longer term.
Well, wait a minute here, because we already are around 4% on mortgage rates here, Chris. If we do see the yield on the 10-year continue to move upwards, and that puts upward pressure on mortgage rates, what's the risk that actually it could cool the housing market and hurt the economy? Because so far this year, right, the economy has been driven in large part by housing.
Oh, no doubt about it. I mean, from where I sit, the two big drivers have been automotive and housing. Both have nice ripple effects. But I think you need to understand really what's driving the rebound in housing. On the one hand, housing is created by jobs. On the other hand, the inventory out there is at multi-year lows. So to some extent, the housing market has to correct in order to see housing start to rebound. So we're starting to see home builders in the DC area really throw up homes. I think that's helping in some other areas. And to me, it says that 4%, 3.9, 4.1, whatever the mortgage rates are, if we're up off the lows, that's going to spur people into action.